In this new segment of Advisor Revelations, the DPL team will discuss how to evaluate new solutions and address current challenges and the strategies that can help you grow your firm and AUM.
Hey everyone, welcome to the Advisor Revelations podcast. I'm your host, Nate Johnson, consultant at DPL Financial Partners. And today we're going to be discussing spending trends in retirement. I'd first like to introduce our guest, Matt Robinson. Matt, appreciate you taking the time today to hop on here.
Yeah, thanks for having me, Nate.
Yeah, so before we get going, really just wanted to remind our listeners to please take time to subscribe to our podcast on, any of your favorite streaming apps or websites. And if anything we talk about today interests you, be sure to connect with a DPL consultant on our website at dplfp.com. And before we get any further, I do want to, have you introduce yourself, Matt. Tell us a little bit about your role here at DPL, how long you've been here, what your day-to-day looks like. And then, that'll give our listeners a little bit more information about you. And then we can get into our discussion today.
Certainly. Yeah. So my role here as an internal consultant at DPL is really to work with our financial advisors on a day-to-day basis and more or less casework, design, reviews, as well as just discussing strategies, helping with the process of putting the contracts in place, and really everything in between, a little bit of service work. Day-to-day, I'm having conversations with our fiduciary advisors, talking about either clients that they have, strategies that they're looking to implement, questions they may have on some reviews that we have done, more education or actually implementation of the annuities. So basically everything from ground level introduction to the types of policies that we have, all the way to client meetings and putting the contracts in place, and really just everything in between. So here to work at any level for our advisors once they're on board and make this process as easy as possible.
Awesome. Yeah, I appreciate you sharing that with us, Matt. So we'll go ahead and get into kind of the nitty gritty of what we're going to discuss today. And really first, I wanted to kind of discuss high level. We're ultimately discussing spending trends in retirement today, but wanted to start with kind of what factors advisors and clients are considering when planning with retirement. I mean, obviously in both of our roles, we're talking to advisors in the industry every day. So just kind of wanted to open it up, have you discuss a little bit about what conversations you're having with advisors on a day-to-day basis as far as retirement planning goes. And then we can get more into kind of retirement spending after going over that a little bit.
Yeah, of course. And, there's definitely no boilerplate conversation when it comes to retirement planning and retirement spending. All of our advisors will know that each client's situation is a little bit different. But there's a multitude of factors to consider when you're going into retirement or looking forward to retirement and how you're going to be spending your hard-earned money. Obviously, expenses is one of the first things you're going to look at. Some people tend to be a little bit more on the debt-free side of things. Maybe their house is paid off. They live a little more frugally, so you may have a little bit more wiggle room with those people. And then you have the people that are maybe retiring early, have multiple houses, maybe have investment, real estate like type income. And so each situation's a little bit different. Obviously, as you get older and you begin to move out of the workplace, things like Social Security income and spending down the nest egg that you've built up. Do you have a pension? Do you have, a spouse? What's the age difference? Do you have any medical issues? Because obviously medical costs are a big factor when you're looking forward to your older ages. Medicare is obviously something that when you get 65, you'll have, but if you retire a little bit early, there's some thoughts of how you're going to fund your health insurance up until then. All those kind of come into play, as well as, like we said, the investment side of the vehicles where you have your nest egg. How is that even divided up? How is it diversified? What type of buckets do you have it in for income, as well as what is your risk tolerance? As some of our advisors will definitely let you know, some clients very eager to be in the market and want every last bit of, the highs and the lows. They're fine with the bad years as long as they can get as much of the good years as possible. And then you have the other ones that just hate to see a negative. And all those factors kind of combine to start that planning process and see how people are going to be spending in retirement, with the idea of you set the plan. You want to have a good look into what you're going to do, but at the same time, you also got to stay flexible because things change, things happen. So it's a very wide conversation, and it can be a very tricky one, but that's a little bit of, looking forward and how you're doing the financial planning aspect of spending in retirement.
Yeah, I agree completely. And kind of what you just said sums up just how complex retirement planning is in general, right? There's not one correct solution or answer. Everyone's situation is different. Everyone has different risk tolerances, et cetera. So kind of bouncing off that, I did want to get into a little bit about a discussion about retirement spending habits specifically, kind of like you mentioned. I mean, some clients want to spend a lot more, early in retirement, whereas some clients kind of put more of an emphasis on saving, spending later, or focusing on legacy planning. So just wanted to get a feel from you, kind of how do those conversations kind of differentiate between someone that might want to spend early in retirement versus spending later? Let's talk about how you're discussing those factors with advisors today.
Yeah, certainly when we kind of look at the different levels. So if you have someone that's wanting to spend a little bit earlier in retirement, especially if they're retiring early and they're wanting to do the traveling and all of that while they're still young and maybe still healthy. And, there's a lot to consider in that. So you're going to want to have a plan for the long run. But the situation where things can get a little rocky very soon if you try to use a bunch of the money and things go a little bit wrong in the market, maybe early. And so you're really trying to take all of that into consideration and make sure that they're still stable in the long run while getting to enjoy the spending that they want to do early on. Because a lot of people say, I want to do this now, I'll worry about the rest later. And then you have the other side of the coin where, maybe people see other family members that have had maybe a health issue in the past when they were in their 80s, and maybe they want to have somebody there to prepare for that, maybe have a little bit more of a legacy for their grandchildren or their kids and their grandchildren. And so they put that off that spending a lot longer, so maybe they're not a burden, or they can leave a legacy. And there's a lot of approaches that advisors can take for this type of spending. For a long time in the industry, there's been the 4% rule. It's kind of been not a generic, like widespread accepted thing, but it's kind of just been one to kind of maybe center different strategies around or work off of. And that's basically saying, we're going to spend 4% of what you have each year, maybe adjust for inflation. And when you have these types of, let's call them extremes, where I want to spend a little bit more early or spend a little more later, then, you kind of have to just work and flex off of that with, kind of the long run taken in mind. And so, like we said before, each case is a little bit different. And some people who say they want to travel, maybe they'll get a few years in, change their mind, or you get the other people that want to put it off for a little bit longer. Maybe they get into retirement, maybe they move and start to experience a different lifestyle, and that changes from there. So that's also where that flexibility kind of comes into play. So that's a little bit of what we see, the conversations that we're having. And like we say, each case is unique. Sometimes when we're talking to advisors, they're considering multiple strategies. And so we're talking about the whole thing as a big picture, but implementing how our solution would help in each individual conversation.
Yep, agree completely. And you mentioned a couple of things: inflation, long-term care, health costs. Just kind of wanted to get in those risk factors and really how those play a role in retirement spending and how those play a role in the conversations you have with advisors. Because, I mean, inflation is something that's definitely going to happen. It's not a certain thing set in stone, right? And long-term care is another thing where you can plan for it, but you can't predict necessarily when or if an event's going to happen. So just wanted to give a feel for your conversations around those two items as well when it comes to retirement spending.
Yeah, a lot of risk factors to consider. That's why, you set up a plan and, like we keep saying, adjust as need be. So one of the biggest things that a lot of people, especially recently, kind of has flared up is obviously inflation. Over the last few years, we've kind of seen what a dramatic shift in that can look like for spending for not only people in retirement, but for people everywhere. And so that's another thing. When you're preparing early on, $50,000 income today is not what $50,000 is going to buy you several years from now, several decades from now. So when it comes to the risk, obviously inflation risk, the more longevity you have, and that's another one that we'll talk about, longevity risk, the more that continues to impact, because this continues to compound on top of it itself. And so spending power is a big worry for a lot of retirees in the long run, because on top of that, when people are retiring in their 60s and we're looking at maybe 20 years of inflation, and then they're getting into their 80s, where statistically a lot of people are going to start having those potential type of long-term care type events or health issues. So you're compounding inflation 20 years from now. You're also compounding medical costs, which also inflate pretty significantly sometimes. And all those kind of come to a head sometime around the 80s for some of these folks. And so it's a big risk factor to try to plan for. And when we talk about long-term care planning itself, long-term care insurance is great. For a long time, we had kind of the traditional use it or lose it type policies. You can get really significant benefits for not much on the premium side. Now, those continue to increase in cost themselves. Many of our advisors out there who have clients that have long-term care policies will notice every few years there's a letter in the mail saying your premiums are going up 50, 70, 100%. You can make changes or continue. So every cost is kind of increasing. If you want to get a policy on that front that's maybe a little more solid, maybe some life insurance backing it, well, now you're having to come out of your nest egg, sometimes with $100,000, $150,000 to get a policy to secure that potential benefit down the road and maybe eliminate some of that cost. So all of these factors kind of go into planning for retirement and that long risk that they have. And inflation and medical costs are certainly ones that most people are aware of, and most people also maybe a little afraid of down the road. And that's why you may run into some people that maybe they want to live that travel life early, but they know those other costs are going to be potentially down the road and they are scared of them, so they live more frugally. So it's all part of the planning process and the risks that are involved.
Yep. I think you did a great job of explaining both those risk factors extremely well. There's one other risk factor I think that's important to cover as well, when it comes to retirement planning, and that's sequence of returns risk. That's something we talk about, every day in our day-to-day with advisors. So wanted to give you an opportunity to just kind of high level, or maybe those who haven't heard about it or need a little refresher, give us an idea of what sequence of returns risk is and how that can have an impact on the portfolio, especially in those kind of early retirement years. And then, we can obviously get into how we can mitigate that risk.
Yeah, I like to pair sequence of return risk a little bit with that longevity as well as kind of the fragile decade. So one important thing to note, retirement spending planning doesn't happen at retirement. There's years and years before where you got to take a look at what you've been doing, what your approach is going to be. When am I going to retire? What changes do I need to make now to, make sure that things are going to be all right when I get to that point? And that's a lot where the sequence of return risk comes in. If you go, let's just use the generic age 65 and you start pulling income from your investments, it's a very significant hit if you have a market downturn right when you start taking money out or right before you get to retirement. And so if you're only taking out 5%, but the market's down 10, you're basically down in a 15% hole in year one. And it takes significant increases year after year to catch up to that while you're still spending on it, as well as, if other expenses occur, you could really shoot yourself in the foot if you don't have the proper diversification or asset diversification to prevent that type of a big hit. Maybe it's savings, different vehicles can help. But in the 5 years leading up to retirement and then the 5 years out is what we kind of call the fragile decade. Those are the most impactful years. And if things go a little bit awry in that, your plan can be completely altered for the next 35 years of your life. And so having the right approach to that, having a little bit of flexibility too, definitely helps with spending. That's why you want to pay close attention to fixed expenses, what you want to do, things like that going into the beginning of retirement spending. And then, of course, longevity also plays into that. If you do have a lot of longevity in your family, those potential sequence of return risk are even further amplified. So it's really important to have a plan. A lot of people use the 60-40 rule, kind of getting into 60% stocks, 40% bonds to maybe pull some risk off the table for when you're approaching. So bigger swings may not really impact your plan, but there's definitely other strategies, which I'm sure we'll get into, that can be utilized for clients.
Yeah. When you discuss that fragile decade, you can look at two retirees with the same exact portfolio and, the same exact investment allocations. And, if they retire in a 2-year differential when it comes to span, and there's a market downturn when, client A retires, and when client B retires, there's a market upswing, there can be a drastic difference in the likelihood that their portfolio has money in it by the end of their life.
In just a few years, we could be talking about a 50% difference between the two. And it's not the most far-fetched thing. Obviously, we've had a good run in the last couple decades for the most part. So it's not been as pertinent of a conversation because not as many people have seen it happen, but the possibility is definitely out there. And for each person between, like we said, market downturns, as well as unforeseen expenses can also kind of help chip into that as far as sequence of return risk. Because if you're having to pull money out ahead of what you thought you were going to, maybe you're only going to do 5%, this year you need a 10, all those kind of factor into compounding that risk.
You got it. Yeah, entirely agree. And kind of moving off that, we talked about a multitude of risk factors when it comes to retirement spending, kind of ending with sequence of returns risk. And you mentioned several of our solutions that we discuss with advisors every day can how to kind of help mitigate the risks we discuss. Just wanted to, kind of open it up to you to kind of discuss how our solutions are being utilized both in retirement and in our conversations with advisors and how it ultimately can help mitigate, whether it be inflation risk, whether it be LTC or long-term care cost or sequence of returns risk. I just wanted to get a feel for how we're utilizing our solutions in those scenarios.
Yeah, certainly. We'll tie this back to the sequence of return risk. Might be the easiest one to kind of start with. So kind of like I mentioned before, the age-old kind of generic investing approach is to back off the stocks a little bit, maybe go to some more fixed income so you can kind of keep the portfolio a little balanced, less risk averse or more risk averse. And so one of the solutions that we utilize a lot is going to be just downside protection. Because if you take out the potential for that loss, you're even in a down year, if your number is zero or the number is minimized compared to what the market's doing, your ability on the return upside of the market allows you to catch up and not also take money out when the account's down. And so the way we do that, it's a multitude of solutions. I would call it a range. So we have our multi-year guaranteed, kind of like CD alternative annuities, where you're getting that fixed rate that would be on the more conservative side of the risk tolerance for clients. But with the insurance companies, the risk pooling that they do, being able to gather more assets, we're seeing more yield from those solutions generally than what you're going to get from a CD. And so those are our more conservative clients that want that fixed return. And then if we push it up a little bit, we can move into the index annuities, where you're still getting 100% downside protection. So you're eliminating that market risk for the most part. And you're getting, depending on performance and how we're allocating to the indexes, up to double-digit potential returns in the market where rates are at right now. And so you're still tracking the market to a degree, the price return, but you're protecting that downside. So if I have 5 more years before I want to retire, I have a portion of my portfolio that I don't want to see a negative in. I'm okay with it staying where it's at. I just don't want to see it go down. These are great solutions to protect that while also being able to capture a decent amount of the upside. Most of those kind of more conservative clients, if they do have a good year, the market's up 20%, they get 10, they're fine with that. As long as they know that they're protected. Those solutions usually come with no fees. So it's very cut and dry what you're getting. And then I would say for clients that maybe need a little bit more growth or not as conservative, we have what are known as registered index linked annuities, RILAs for short. And these are your kind of defined outcome buffered products that allow for more return on the upside, protection on the downside. Maybe it's a 10, 15, 20% buffer. So you're eliminating some of the loss, even if there is a drastic downturn year. But because you're accepting some risk on the downside, you do have potential for almost 20% upside with some of the solutions out there. And there are several strategies that we can implement for longer time horizon with that as well. And so that's how several of our solutions, just on the accumulation side, can help provide peace of mind, which is annuities are going to be goals-based solutions. So we always want to tie it to a goal that we're striving for. And if you're looking for protection as well as some upside, maybe take some risk off the table, those are some great solutions for accumulation.
Yep. And those go right into what we were talking about, helping mitigate sequence of returns risk, right? While also still allowing you, at least in the fixed index annuities and buffered annuity space, to participate in market upside, right? So it's kind of the best of both worlds there. I wanted to also kind of get into those other factors we discussed, a longevity risk, inflation risk as well. Kind of talk about how some of our income solutions can help mitigate those risks and are being used by advisors as well.
Yeah, this has certainly been the last 2 or 3 years has been a really good time to kind of look at guaranteed income in the annuity space with the interest rate environment that we're in. A lot of our conversations do center around review. So we're looking at maybe some older annuities with an income rider that we're able to increase. But when you look at just the planning aspect of it, we have many advisors here that have the clients that want that guaranteed income. They want that pension. The guaranteed income riders do provide basically a self funded pension. I think at this point, I saw a stat the other day, 22% of people still have a pension in the United States. And I'm assuming that number is just dwindling by the year. It's a very hard thing to come by. And so relying on yourself to build up the assets and kind of get that guarantee, that's where these guaranteed income solutions kind of come into play. We talked about the 4% rule of your, again, 65, drawing down 4% of your portfolio. If I remember correctly, it's upper 90s percentile on the like Monte Carlo for that rule. Obviously, each situation is different. And that's more of just a rigid use of the 4% calculation. But if I can, at 65, use a portion of my portfolio to maybe guarantee 7.5% of that money for as long as I live, doesn't matter if the account value goes to zero, well, then I maybe have some more flexibility in my other investments. Maybe I do provide that base expense cover, and the rest of the assets can maybe grow more because I'm putting less strain on that part of the portfolio. There's a lot of different strategies to take when it comes to guaranteed income, but in the end, with the risk pooling that the insurance companies are able to do, because they have many lives that they're basing all of these on, they're able to generally provide a very good payout for our clients, whether it's immediate income or income in the future. And that's where our advisors are kind of hedging or providing that peace of mind for the clients with the guaranteed income solutions.
Yep. And that peace of mind, whether it be from a guaranteed income stream or from a solution that has principal protection, is ultimately going to give, the clients more confidence in retirement because they are mitigating those risks and ultimately giving them a license to spend and having more of an opportunity to feel comfortable spending, in retirement, knowing that they have that floor that they've set for themselves when it comes to an income stream. Well, Matt, I appreciate you hopping on here today. I do want to thank you for, providing that insight. Do you have any final thoughts or closing comments or anything you'd like to share before we hop off here?
Yeah, I always like to tell my advisors, whether it's if you have an old annuity contract that has income, as long as it's not annuitized, we can take a look at it. We may not be able to improve the client situation, but surprisingly enough, we've seen a lot of scenarios where the contract may be what we call like underwater. The income number that they're generating is based on a higher payout. We're still having success with those. And anytime a client's already taken income, generating more is always a good story. And then, if you're kind of curious, if you're just doing some planning and you would be curious to see what an annuity could do, whether you want to implement it for that client necessarily or not, reach out, send over the numbers. We're happy to just kind of show you how it would implement almost as a case study, if you will. And that way you'll know kind of what to identify going forward when you may come across another client situation to reach out and look to implement that into their portfolio, as well as what I would call fixed income alternatives on those kind of protected growth assets.
Yep. I think that's a great way to close, because either way, regardless of if the annuity solution makes the most sense for the client in this scenario, it's ultimately going to give the client peace of mind in, whether there is a better solution out there or, whether what they're using right now is what fits their retirement goals best. Well, thanks everyone for being on with us today. And again, obviously we can connect at dplfp.com and obviously subscribe for more episodes wherever you get your podcast on demand.
Thanks for listening. To hear more Advisor Revelations, go to dplfp.com and subscribe on your favorite podcast streaming app.